Good afternoon, and thank you for joining us for the webinar today on law firm taxes. We appreciate having you on this Friday afternoon, and we will get started now. Hang on one second, make sure my technology is working perfect. So I'm Donna Jones, president here at Advocate Capital. And for those of you who have not joined us for a webinar previously, just a little intro and information about Advocate Capital. We are a financial services company for plaintiff law firms, and we provide lines of credit through our AdvoTrack case expense funding service, which allows the interest pass-through feature. And so with that, we're excited today to have with us a really special guest, Rob Wood, who is one of the preeminent tax lawyers in the country. And we do a webinar with Rob just about every year for updates on taxes for trial lawyers. But I'll give you a quick rundown on his bio in case you haven't yet had the opportunity to meet and learn about Rob. He's often listed among the top 10 tax lawyers in America, and he's the managing partner at his firm, Wood LLC, located in San Francisco. He handles a broad range of tax planning and tax matters. He also serves often as an expert witness on tax matters in civil cases, class actions, tax matters, all across the board. He's a widely published author. He's known for explaining and simplifying complex tax issues, which I know would be super helpful for me. He's best known for his expertise, and he advises not only plaintiffs, but defendants, lawyers, settlement funders across the industry. He did author the leading book on this topic called Taxation of Damage Awards and Settlement Payments, as well as the Bloomberg Tax Management Portfolio Aspects of Settlements and Judgments. There's a lot to learn about Rob. He is indeed an industry expert, and we're delighted to have him today. Rob, thank you for joining us.
Thank you. My gosh, I'll do my best to try to demystify something here today. Thanks for the introduction.
All right. Well, let's dive right into our content today. First of all, a quick disclaimer. We're not here to give you tax, accounting, or legal advice today. We're here to share some information, perhaps some recommended best practices, talk about some leading topics in the industry, and at the end, we're going to introduce you to a new concept. Hopefully that will be informative and helpful for you. So again, for those who haven't participated with us in the tax webinar for trial lawyers in the past, we want to start with a topic that's important for plaintiff attorneys, and that's case expenses. And where should those appear in the firm financial statements? And so two concepts here today, financial statements, accounting in general, and then Rob actually will speak to the tax implications. And so when we think about case expenses in the law firm and how those should be booked in your financial statements, it's generally recommended that case expenses are booked as a loan, an account receivable, if you will, to your client, which would properly appear on the balance sheet, which also then leads to the question, well, what if I expense case costs on the P&L? And so with that kind of as the backdrop to start this part of the discussion, I'm going to hand it off to Rob and ask him to give us a little background information about this IRS private letter ruling 824-6013. Rob, take it away.
Thank you, Donna. So this is not a trial lawyer's friend. And I think over the years, over the decades, I guess, I've seen a lot of confusion and a lot of maneuvering on trying to deduct case costs. I think most of you, most lawyers, most plaintiffs' lawyers know this rule on some level, but essentially the IRS position, which they litigated for a lot of years, is that if you are, as most plaintiffs lawyers do, if you are advancing costs for clients, it's a contingent fee case and the client's not paying ongoing costs, rather you are paying those out of your own pocket, Your instinct, of course, is to deduct those. If you pay FedEx, you pay court reporters, you pay for travel, for depositions, etc. Your instinct is, gosh, those are expenses you have as a law firm. You ought to be able to deduct them. The IRS view is you can't. It's essentially a loan. You recover them at the end of your case. I think there's more pressure on this now in the last few years as litigation gets ever more expensive. I think there can be. It's worth talking about it, and if you're not doing it correctly, as I've found many lawyers aren't, it's worth looking at how to transition out of that. Do you need to do anything about the past, etc. I also think, just to leave this topic, I also think that there may be a different theory for multi-district kind of case costs. Sometimes there's a fund that you contribute to. Those may not be the same as regular costs. So all I would say is, if this is all kind of news to you or unfamiliar, or you're deducting these, if you get audited, I think you're going to fail. So it's worth trying to get ahead of it if you have this issue.
So a quick follow-up question, Rob. In your practice and your experience as an expert on these topics, have you been able to help law firms who perhaps were booking them incorrectly to, get to the place where they are doing it correctly? Is that something that you've worked on in the past?
Yeah, no, it is, yes. And I'm happy to do that if anybody wants to call me or email me.
Okay, excellent. Moving on. And so when we think about deducting client costs, there are a number, I know, of considerations primarily driven around the fee agreement itself. If you would, Rob, take us through these line items and how that impacts the way a law firm should book their advanced costs.
Sure, and I think there's so many other things to talk about. I don't want to waste too much time talking about costs. Some of these, I guess, topics here, like what's the difference between a gross fee agreement and a hybrid? I think the short answer, which you all probably know from what the kind of bleak picture I painted a minute ago, is the IRS is likely to view just about anything as non-deductible until your case resolves. So I think if that's the treatment you're applying across the board, you're doing it right. You may not be happy about it. If you're doing less than that, I think it's worth talking about your specific facts, because it's kind of hard to give a litmus test for what might work on these things.
Okay, understandable. In addition to the IRS.
Oh, by the way, sorry, Donna, just to say, because maybe viewers, so you'll see in the slides here some references to things that I've written, like this article from 2010. I'm sure you can't click on these in the slides, but if you go to my firm's website, which is Wood LLP, .com. If you go there, there's an articles page, kind of an archive, and there's a search window. And if you paste in this title or any term from the title, like Boccardo is the name of a tax case, kind of a famous tax case on this, you can pull up a lot of free articles and you can download them. And there's thousands of articles there. So it's likely if you typed in a term that you're looking for, you'd probably find some articles and they might help you.
That's great information, Rob, and thank you for backing me up on that.
Sure.
I think at the end, we're going to have an opportunity for some Q&A, and we're also going to provide some contact information so that our participants can easily navigate to your website, check out those articles, and perhaps schedule a consultation if that's helpful. So thank you for that.
Sure.
You mentioned the Boccardo case, and that's a great segue because that's our next slide. And so again, thinking about the IRS private letter ruling, what we've talked about thus far on costs for plaintiff lawyers, what does the Boccardo case tell us?
Yeah, again, I'd say more of the same. It's a Ninth Circuit case, and as in often the case, Ninth Circuit in the West Coast is a bit of a maverick circuit, but I would say the safest thing for listeners to do, even in the Ninth Circuit, is to assume you're not supposed to deduct client costs until your case resolves. So I know I'm sounding like the IRS today, but I think on this one, we should kind of move on to the other topics where there's a lot more flexibility.
Okay. Very good. And I think, it's important to mention those things because, as you said, probably every trial lawyer on the webinar today, or even those that might access this content later, will have heard of either the private letter ruling or perhaps the Boccardo case. And so with that, we'll...
Yeah, and by the way, Donna, sorry to interrupt. One other thing, and I don't know much about lobbying. I mean, occasionally I have clients who have lobbyists, but excuse me, the trial lawyers of American Association for Justice and maybe other kind of groups, I think have made a run at this at least once or twice that I remember historically, trying to get Congress to make it so that that the costs are deductible. I know whether trial lawyers are popular with Congress, I don't know that. I know that kind of goes up and down over the years, but I mean, I don't think it's a silly idea, that is, to try to get it changed. I don't think that's an unreachable goal, but I don't know what the timing or the cost of doing that might be.
Okay. Thank you for making that point. I'm sure a lot of trial lawyers on the webinar today probably had that same thought. Just because that's the way it's always been, does that mean it's the way it always should be? And so good to know that at least there have been attempts in the past to change it. And, since you have so much expertise in this area, Rob, just a general question. How much effort, how much of an uphill battle is it generally to get the IRS to change their position on a topic like this?
Gosh, maybe later we'll talk at least briefly about the structured fees and the recent IRS so-called glam that the IRS came out. I mean, I think getting the IRS to change its position, getting the IRS itself to change its position is generally hard. That won't be a surprise to anyone. That's, I guess, true, on an individual audit case if they're looking at your, books and records and tax returns. I mean, it's often difficult to push back, which is why many cases go beyond the audit level to IRS appeals, for example. But if it's something like a policy like this, Boccardo / case expense issue, I think the chance of getting the IRS to change its view is pretty much nil. On a sweeping basis. That doesn't mean you couldn't perhaps convince them that you're doing it okay, but I think generally they're going to keep saying this. Getting Congress to change the rules. Congress passes the tax law, after all. I mean, that's different. And I've seen lots of tax bills introduced over the years, and sometimes I think it ought to be super simple. It's obviously, it should pass, but it may not for a whole bunch of reasons. And then conversely, I see things that I see proposed multiple times, like tax treatment of payments to exonerees, people who are wrongfully convicted of a crime and end up getting money. I saw that introduced multiple times. And then one time when I wasn't expecting it, it got added to some other bill and boom, the law got changed. So I don't know, I'm sure a lobbyist could be an interesting guest for you to have, but it's that old thing of sausage being made, I think.
Agreed. Well, at least you give us hope that it might change one day. Quick note, our marketing team just advised me, we will provide links to all of Rob's work in the webinar recording release. So for those of you that are trying to jot things down, we'll make sure we get that information to you. All right, okay. Oh, very good. So you mentioned fees, and we're kind of starting to segue into that topic about taxes and whatnot. And so if you would, Rob, maybe just take a quick run through on these type of taxes, I guess, that a typical plaintiff's firm should think about.
Sure, and these are not fun topics, so my apologies for on a Friday afternoon giving everybody kind of grim news.
But they're important.
Yeah, I mean they are, and I do see, you know, a wide variety of things, and I guess not surprisingly, I often see things when they go badly, when there's a problem. So, I mean, no matter how successful your practice is, you know, and what kind of headlines you're getting, think about your kind of internal organization, and part of that is about tax. So we're not talking, you know, very broadly about law firms. Should they be C corps, S corps, partnerships, LLCs? You know, what are they? And state laws is certainly relevant. C corps, I mean, I rarely see them, but I just saw one today, as a matter of fact, a law firm that kind of surprisingly was a C corp. So I think about what what entity you are, what do you want to be, and what tax does that bring with it? Income tax for everybody. So whatever kind of organization you are, there's individual income tax, and in some cases, like the S corp or C corp I just mentioned, in some cases, of course, entity level tax. Self-employment tax. If you're a partner or a solo, you're going to pay self-employment tax as well. And then in withholding, if you're an employee, as you would be, say, for an S corp law firm, even if you're a partner, quote unquote partner, a shareholder of the S corp, you're going to get a K1 and you won't have withholding. So I think most lawyers are probably in the boat. Most kind of owner lawyers, I should say, are in the boat of not having withholding. But if you're an employed lawyer, and you may or may not be called a partner in a firm, but if you're an employee, you're going to get a W-2, and that means wages with withholding, and then typically a bonus with withholding. So I mean, think through those kinds of things. Lawyers this is a kind of a problem that's I rarely see with lawyers, but it's a problem that's universal for any business, and that is if you have employees, legal assistants, administrative people, employed lawyers. If you're withholding taxes, you got to send the money in right away to the government, and so payroll tax issues and problems and failures are usually more serious than income tax failures. So again, if you have that problem, get ahead of it and get some help, because you don't want that to fester.
Absolutely. And so, Rob, if a lawyer is with us today and has a question about, what would be the best entity or structure, especially one that's starting a new law firm, these materials that we have referenced on the slide would be helpful. And of course, they would want to consult their own accounting professional. Would you agree with that?
Yeah, and I think, there's nothing wrong with getting tax advice from your accountant, but there's also, just like with lawyers, a great sort of variation in sort of skill sets. So I would say, it never hurts to make sure that you're getting an informed view from your outside lawyer or tax lawyer if you have one, or accountants. But yeah, I think the more you talk about these things, kind of the better generally.
Okay. Very good. Well, we're going to move into kind of more the meat of our topic today, I guess, if you will. And so a popular discussion point among trial lawyers over, I guess, what, the last 20, 25 years maybe, has been QSFs. And so I thought we'd start here, Rob, and if you could, just kind of share the basics. What is a QSF? Why might they want to consider one? Those types of things, if you would, please.
Sure. So QSFs are qualified settlement funds. It's a creature of the tax law. They, as Donna says, I mean, they really have exploded in growth. I mean, I guess I've been seeing them for increase for more than 10 years. And I've written a lot about qualified settlement funds and advised many of them and advised people about forming them, and administering. They really came into the law in 1993 as a creature of regulations. 468B of the Internal Revenue Code is the sort of authorizing code section, and the regulations really have all the rules, and they are essentially, I think a lot of plaintiffs lawyers find it surprising that QSFs were really today are viewed as a plaintiff tool and a lawyer tool, but these QSFs were created to help defendants,
Right.
so that defendants could get tax deductions. So, I mean, many defendants, I don't know if I can say most, but are used to them. I think most plaintiffs lawyers are used to them, and that's good as a kind of a tax neutral stopping point or way station between defendants and plaintiffs. And I would put lawyers with the plaintiffs in that example. That is, the lawyers and the plaintiffs can defer tax and figure out who should get what, resolve liens, whether you want, when I say you, let's say whether the plaintiffs want cash or structures, and the same thing for lawyers. I think they are enormously flexible, and I guess if I have to sound a note of caution, it would be the fact that they are so prevalent does lead to some abuses, and I see them, and I know the IRS sees them too. There is discussion underway of the IRS about updating these pretty old regulations. Because QSFs are used so often today in so many ways. And I think the IRS has said that they're going to look at some of these abusive situations. We don't have time, I don't think, in this kind of a discussion to go in depth. But if you are a major user of QSFs, just think about what you're doing and how you're doing it, and, for example, how long you're keeping a QSF around. Is it only your money? Those are the kinds of issues that I would want to flag as saying you should think about it, because it's not just a bank account to be used in that way.
Okay, so if I understood what you said correctly, you can't just deposit your settlement funds in a QSF and leave it there in perpetuity. Would that be? Is there a preferred length of time, maybe?
Yeah, I mean, I think some of the commercial providers say, and this is kind of a rule that that I have said as well, that it is designed. I mean, as you'd see if you kind of read the literature about them, as this kind of resolution device, this wonderful, neutral vehicle that gives your plaintiff clients choices about when they get their money and how they get their money, and figure out many of the things that they can't figure out when they're being expected to hurriedly sign a settlement agreement.
Mm-hmm.
And so it's great for that. And it's also, frankly, great for the lawyers to time income, within reason to time income, and to facilitate structures once you get rid of the defendants. Sort of get them out of the picture. However, if it's only your money and it's sitting there, the rule of thumb is don't keep it around more than a year. there's no rule that says that's a safe harbor or that the IRS can't, attack you if you've got a QSF with just your money sitting there for a year. But I think the older it gets beyond that, the worse it looks. And there is a kind of a latent fear that the IRS could say, sure, QSFs are kind of a block to any kind of constructive receipt argument, but enough's enough, and you're using it in a way that you're not supposed to. So I'd say a year would be a useful benchmark.
Okay, and we're talking about just in terms of the attorney's fee. I guess if it's an MDL or a complicated matter where you have hundreds or thousands of plaintiffs and it just takes a long time to pay out the proceeds, that's one thing, but we're just talking now about the attorney fee, correct?
Yeah, Donna, thank you. Yeah, I certainly don't, I really appreciate the clarification. I don't mean to suggest that there's anything wrong with, in terms of the tax law, anything wrong with a QSF that, and I've personally been, advising QSFs or QSF trustees or lawyers when the case is going on for 7-8 years, and it just takes forever for everyone to find, sometimes it's like an airline crash or something. It takes a long time to find people, takes a long time to resolve claims. Many times there are big fights among the lawyers, among the various plaintiffs and family members, and all of that stuff is fair game. I mean, in the IRS, and I think, you may not like having to litigate something for a bunch of years, but in terms of the tax law, that's precisely what QSFs are for.
Okay, makes perfect sense. And so let's dive in. You touched on the topic of structured legal fees and the concept of constructive receipt. And so if you would, Rob, I guess maybe share a little more to help our listeners, especially first timers on this webinar, understand what is constructive receipt.
Sure, and it's one of these, I mean, I guess because I see it so often, it seems simple to me, but I think a lot of it really isn't. And lawyers, I think many lawyers sort of don't see the sort of subtlety of a couple of differences. I'll try to give you a couple of rules here or examples in a second. And I'd say for clients, it's even more true for clients that it's a confusing concept. So I'll mention QSFs in a minute in this context. In this article at the bottom, Lawyers and the Constructive Receipt Doctrine, I think it has some useful things in it that might help you. You might want to look at that one afterwards. But so one sort of obvious constructive receipt issue is that you settle a case and the money hits your IOLTA account, and you've got it in your IOLTA account. You haven't dispersed the money to you, to your firm, or to your client. And you say, well, gosh, okay, what are my choices now? That's worth, I mean, if you are willing to have some risk, it's worth a phone call, I think, about that. Because the short answer is it's too late. You've got it. And it's not merely constructive receipt, I would say, it's actual receipt. So you've got it. And clients and lawyers, I find this, I think, hard to fathom how this could be true. But usually when money hits like that, you as the lawyer are attributed your share. So if that's, let's say, 40%, even though you haven't moved it to your operating account, it's probably your income then. And likewise, if the client's piece is 60%, the client's got that, got that as well, even though it doesn't go to the client yet. I've had cases, and you may have seen them too, where you get some big slug of settlements on December 27, and sort of what do you do? And I think there can be some workarounds, but that aren't perfect. But I think the short answer is you should assume, assume it's income, unless you can figure out one of these workarounds. So that's the most, I think, the clearest circumstance. What if you are poised to sign a settlement agreement and you as a lawyer may not sign it at all, or you might approve it to form, but the client's about to sign. The client signing a settlement agreement triggers your right to fees, even though you don't sign the agreement. That's your, I guess, constructive receipt, if you will. The settlement agreement signed, and it says they're going to pay you within 30 days. What if you go back to them and say, oh, wait a minute, I changed my mind. My client wants a structure and I want structured legal fees. I'd say it's too late to do that. It's too late because the agreement's signed. You don't have the money yet, but you have constructive receipt because the agreement says within 30 days they're going to pay you. I mean, maybe there's a Hail Mary pass you could amend if you're amending about something else. But once again, it's kind of a don't try this at home. The IRS would likely say that's, constructive receipt has attached to you and your client because of that. Timing is different. So you sign the agreement. It says you sign the agreement December 15. It says they're going to pay the case. You're going to pay your trust account, in 30 days. You can see this one coming. The money hits December 30. I think that's December money. What if the money doesn't hit until January 5? Well, you lucked out. That's not income until the next year. So year end, you might want to think about that and not just have they're going to pay in 30 days because you don't want to be surprised. You might want to say pay within 30 days, but no event before January 2 or something. Year end, there's a lot of that. If you condition a settlement agreement on that kind of a term, that's not constructive receipt. You're just saying that's what we got to have. Now we'll sign. Similarly, if you sell your house, you can condition it on being paid in installments, as long as you do that before the agreement is signed. But if you sign the agreement and it says they're going to pay you $1 million for your house, and then you say, well, wait a minute, I actually want it to be paid in 10 installments, it's too late. So that's sort of a short indoctrination of the many nuances of constructive receipt, which I think is a constant problem for taxpayers and for lawyers.
Okay. Well, thank you, Rob. I think those very practical examples are enlightening, and it seems like our participants or trial lawyers in general need to be making these decisions before the settlement agreement is even signed. Would you agree that's probably a best strategy?
Yeah, I mean it's always good to and some of these points are obvious. It's always good to think about it in advance. I guess one of the things I do a lot of, apart from advising lawyers on tax issues, I guess even more frequently, I'm advising plaintiffs kind of every day on tax issues. And so, and many lawyers know that they don't want to be really giving the client tax advice. So telling the client, hey, don't forget about taxes, or you may want to get some advice, is smart. I think circling back to QSFs, one of the sort of fundamental, wonderful things about QSFs is that they allow time. Because if you kind of, in the examples I was describing before, if you kind of can't decide what you want, a good holding pattern is to say that all the money goes into a QSF, and then you have some time to think about it later post settlement.
Okay, excellent. We will move on. And so you've talked about some of the things that a lawyer should consider with regard to constructive receipt. And then we also have some information of just, I guess, general benefits, pitfalls. What would you add to that discussion based on the information on this slide?
Yeah, so structured legal fees are, I think most plaintiffs lawyers, I would hope most plaintiffs lawyers are somewhat aware of what that topic is. The term structured legal fees really refers to something I guess you could say is an expansion of what I just described with constructive receipt, or maybe it's an exception. So you are entitled in your fee agreement, presumably, to a contingent fee based on, excuse me, when the money comes in for the client, when the client settles, or when a judgment is paid, if in the case of a judgment. And so that's kind of what triggers your right to fees. But if you kind of follow the path of structured fees, you can say, before it kind of turns into money, before you have this legal right, you can say that you want your fees paid over time. It's something that hourly lawyers like me do not have. It only works for contingent fees, and it's something that the U.S. Tax Court and the 11th Circuit approved. There's really only one classic case, the Childs case from 1994, I think it was. And then it was affirmed, I think, a year or two later by the 11th Circuit. And basically, that case, and really the infancy of the structured legal fee industry, it all comes from structured settlements. It's the same kind of methodology. And structured settlements, which have been around since the early 1980s, or maybe even before, but the early 1980s, they kind of took off. And you probably are familiar with those for your clients. So it's kind of, do you want to be paid over time instead of a lump sum, kind of even out your income? And as anyone trying to sell you on structured legal fees will demonstrate to you, a little bit like a non-limited retirement account or something, because money can grow on a tax deferred basis as opposed to tax after tax basis. So, I mean, there are a lot of choices. Originally, the Childs case was about life insurance annuities, and there's still, I think, a dozen or so U.S. life insurance companies that write annuities for structured plaintiffs and for lawyers, structured fees. But there are also a lot of other choices now that are market-based. And I guess finally, you should be aware that the IRS is at least kicking the tires on these things more than they used to. And so it's a good time to get advice about them if you are looking at structured legal fees.
Okay. Great. Well, we're going to move on into
Sorry, Donna, just before we leave that, so I'm not overly cryptic. When I said the IRS is kicking the tires, it looks like I didn't include this, but I just within the last month or so wrote an article that I can provide to Donna about the IRS GLAM. This is this generic legal advice memorandum the IRS issued in December. I guess it's a couple months ago now, essentially attacking or saying it was going to attack structured legal fees on certain facts. I don't think anyone really knows how broad that attack will be or could be, but it's the IRS really saying the first negative thing about structured legal fees that they've said, in the last almost 30 years. So it's causing, I don't know, shockwaves may be too strong a term, but it's causing people to, I think, be more careful about structured legal fees. It certainly doesn't mean you can't do them. This IRS memo isn't binding on anybody. And I guess I view it as, in some respects, it's a good thing to be Pollyanna, because it is making some people focus more on the details as opposed to just sort of slamming something together. So it's worth looking at that if you're not aware of it.
Awesome. Well, thank you. Yes, and that is relevant and very current, and I'm sure some of our participants probably had questions about that. We are going to move into just a very high-level overview of a new concept that Advocate Capital and our banking partner, Pinnacle Financial Partners, has been working on for, gosh, I guess close to 2 years, Rob. Speaking of not getting in a hurry to do anything and being strategic and careful. And we asked Rob to talk to us a little bit about this because he has been engaged and provided the tax opinion on this new strategy. And so I guess, Rob, if you would take it away and talk us through how this is the same, different, better, or anything extra than what we, I guess, think of in terms of a standard structured legal fee.
Sure, I think, well, and I have to stress that, yes, although I've had a role in this, I assure you I'm not I don't get a commission off of, I'm not good at sales, as I guess is obvious. But I mean, I think it is an innovative, product or sort of group of products, kind of meant to be sort of a soup to nuts, sort of integrated thing offered by several companies working together. And so I think in that sense, it is pretty neat. For, I guess, busy trial lawyers who want to structure fees, want to have the flexibility of a qualified settlement fund with fees, and want to take advantage of borrowing, because this is a kind of a combination or kind of mashup, if you will, of a structured legal fee and loan. One of the things I guess I should have said earlier is that when I mentioned the child's case, is that in the child's case and annuities, it didn't involve any loan. And yet the way the industry has moved, many lawyers who structure fees are anxious to borrow money and you can't use the fee structure as a technical matter as security for a loan. And the way structured legal fees have to be documented, you are a mere payee of the money. Basically, you're much like your clients who structure their plaintiff recoveries. It's kind of a similar format. But in any case, loans have become really popular. I think there's always some possibility that the IRS could try to integrate the fee structure and the loan. One of the things I like about this Pinnacle structure is Pinnacle is a real bank, a large bank, and this is quite an independent undertaking that it underwrites the loan and then makes a loan, and it's really combined with the fee structure that is in working with Dominion, which is the assignment company, that they've sort of timed the loan and the payments made under the structured fee arrangement so that it's kind of no muss, no fuss for paying down your loan as you receive these payments. So it's I'm not doing a good job of selling it, but if you read some of the literature, and I think there's an FAQ document that's actually really could be really helpful, saying, you probably have these questions. Here are some of them, and here are the answers. But it is, I think, an innovative program that may be attractive for plaintiffs' lawyers.
Okay. And so, with regard to the structure, the QSF, the assignment company, it's a complicated transaction, to say the least. And I guess for me, Rob, and please correct me or please elaborate. So the concept is that the lawyer would deposit the entire settlement into the QSF, and then for that'll stay until all the plaintiffs are paid, all the liens, that sort of stuff. That doesn't change. but with regard to the attorney's fee, that is paid to the assignment company, who then purchases an annuity, and then the bank effectively is lending against the annuity with periodic payments. Is that close, or can you help me out here?
Yeah, no, you did a better job than I do. I mean, I think I'm rounding off some of the edges, and you are a little bit too, but I think that's absolutely the concept. And I should say, I mean, I didn't even mention independent life before. I mean, the other kind of important player in this, I guess, unfolding strategy is independent life, which is I mean, kind of the newest and most innovative insurance company around, I think. And their iStructure product, which is an indexed annuity without a cap. And I only know, I guess, the things I need to know about insurance companies as a tax lawyer, which is certainly not a big universe of things, but and this really is not a tax point, but I think that the iStructure is an unusual annuity because it is indexed. There are lots of other indexed annuities, I think, but this one doesn't have a cap. My understanding is that may be the only one that way. It's quite unusual, and so I think for lawyers who want to structure fees, I mean, many lawyers want to structure fees, and the reason, in my historical experience, that they don't tend to like annuities, the old child style annuities, is because they want sort of more market, market play that is more upside. So that they're using, or more likely to use, these kind of market-based products that insurance companies don't offer, but other structured fee companies do. And but I think this iStructure is kind of a nice answer to that, to the people who only want to use the market-based products of stocks and bonds, because iStructure is kind of the best of both worlds, I think, because it's an annuity, and it's therefore, I guess, safest, safer than the market-based ones, perhaps, and it's in terms of IRS scrutiny, if there ever is any, it's an annuity, and therefore it's closest to the child's fact pattern. So I think that's again, one of the other kind of pillars of this, of this new product.
Okay. I guess anytime a new strategy, a new concept like this enters the marketplace, there's a lot of questions. And just for the benefit of our participants, you're kind of getting a sneak peek today, if you will. The plan is to have a full launch of this product probably in second quarter. And so understanding that, you've probably heard some new things today that are different than what you know about a standard structured fee agreement. If you'd like a copy of the FAQ document that Rob mentioned, please send us an email at webinars@advocatecapital.com, and we'd be glad to get that information to you. I think the teams that are involved in this launch tried to do a good job anticipating the questions that lawyers would have about this new product. And so anyway, also, if you feel like you have a settlement on the horizon, or, in the near future for sure, and you'd like to schedule an actual consultation appointment to speak with our team of experts, we'd be glad to help you set that up as well. Again, I'm like Rob, I'm terrible at sales. I'm not here to sell anything, but do want to let you know that we've got a lot of information available about this concept, and we'd be glad to share that with you. Rob, as we, I guess, tidy up on this new product at the end, other thoughts or comments that you'd like to share with the participants today?
I guess I'd say, kicking the tires is a really good idea. I think some lawyers are, I think of as a tax lawyer, most tax lawyers are conservative, sort of scaredy cats. I think that's accurate for me. And I'm always interested in, I tend to think of plaintiffs lawyers, especially, maybe all plaintiffs lawyers, but certainly, especially ones that are, very successful. I tend to think of such people as big risk takers. But I think we all kind of compartmentalize. And so I've met a number of plaintiffs lawyers who are super aggressive when it comes to, many things. And yet when it comes to investments or their taxes or something, are extremely conservative. And that's okay. And, maybe it's even good. But I think for me, I always try to get a sense for sort of where somebody fits on the risk profile scale. It's because it's not always obvious, and you may you may not be in the same kind of risk boat as the lawyer next door to you. So I think thinking about your own circumstance and describing that to whoever your advisors are is important. I think the other thing I would say is looking at multiple choices is not, I don't know if it's ever a bad thing. And I think some people get maybe sold hard on something by a broker, and and I think many brokers will, if you ask, will offer other choices so that you can compare. And if you're not being offered that, go out and find it on your own. I think it's a good thing to compare other choices so that you're making it's kind of like buying a car. If you're looking at multiple choices, you may get more of what you want and make a better decision than you would if you have kind of a single vision. And I think finally, your own tax person, you may have someone that you like and trust, and I think it's that person may or may not be informed about these things, but if you have someone that you trust, that's also not a bad thing to bring them into the fold so that they understand what you're doing. Even if you end up getting different perspectives, somebody saying, oh, this is the best thing in the world, you should do it, and somebody else saying, you're crazy, don't do it. I think those perspectives are good to hash through too, even if it's not especially fun.
Okay, great points. We are almost out of time today, so I'm going to try to wrap it up and open up the chat box for questions. Looks like, let's see. Okay, so first question, Rob. In regards to the legal fee lending solution product, do I first collect my contingent fees?
No. I mean, you want to be ready to, but no, you don't. You don't want to end up with the money in your IOLTA account or the money about to hit your IOLTA account. You want to get ahead of it, and if you've got to sign a settlement agreement tonight, you want to have the settlement agreement say that the funds are all going to, AQSF that's been established, so that you don't have constructive or actual receipt of the money.
Okay, and that's where I was going. So we're back to the original discussion that we started early in the webinar about constructive receipt. And so those same concepts that you talked about earlier obviously apply to this new strategy as well. Would that be correct?
Yeah, they absolutely.
Okay. It looks like we've got several items coming in. So I think probably our best strategy, I've got Rob's contact information. Am I showing? Yes. On the screen. And so if you'd like to consult Rob, if you'd like to get more information about the cases and the materials that he's talked about today, we have his information for you on the screen. Rob, do you prefer email, phone, both, or does it matter?
I mean, it's, I guess my preference is just because sometimes my phone volume gets really high. My preference is email, but I'm happy to do either way or both, whatever works. I'm happy to
Okay.
try to answer questions.
Okay.
And I would also say, I mean, this isn't our topic today, but I find lawyers, like anybody else, can have all sorts of tax issues. So I mean, this is, I suppose, kind of my bread and butter, these kinds of tax issues. But I see lawyers who are doing, for example, litigation funding, doing either a single case or a portfolio of cases. So I see a lot of those kinds of tax issues as well. And and I write a lot of tax opinions on things about timing of income or structured fees or QSF. So happy to field questions whenever they arise.
Fantastic. And so that email address is wood@woodllp.com if you'd like to reach out to Rob directly. And then also, just to wrap up today, if you would like the frequently asked question document about the new strategy that we talked about today, please email us at webinars@advocatecapital.com. We're trying to channel those inquiries a little bit differently. And if you'd like more information in general or have a topic that you'd like to have discussed on one of our webinars, please email us at www.advocatecapital.com. I want to thank everybody for joining us this afternoon, especially thanks to you, Rob. We really appreciate all your time and your words of wisdom and advice. Any closing remarks you'd like to leave with our participants?
No, I will say, I hope no one calls me at 3 a.m, but I will say I noticed that my main number is listed on the slides. And I can give you my direct dial a number that, and I of course have voicemail that comes directly to me. And I'm one of those old-fashioned people that if I can, I answer my own phone. But my direct line is 415-834-0113.
Thank you. Well, you're very kind to offer that, and probably brave. I'll just say that.
Maybe stupid.
No, never ever that. Thank you again, Rob. Really appreciate your time and the discussion today, and we look forward to talking with you again in the future.
My pleasure. Thanks, everybody.